Hello, welcome to Tactical Trader Bootcamp's free Forex training tutorials. This video we're going to be talking about your position sizes on your trading lots. Now before we continue with that, I need you to pause and just go through this disclaimer if you haven't read one already. They are all over the website and on my on the videos. So please, before you continue, you have to understand that trading is a risky business. Please understand that Tactical Trader Bootcamp is in no position to give financial advice or give any advice on what to trade or what not to trade. So please read that and we'll continue in just a second. Okay, thanks for taking your time out to read that disclaimer. So on with the video. Now, before you place a trade on any sort of Forex or stocks, you need to figure out what position size you're actually going to be trading with. You can't just pick a number out of thin air. The position size is all relative to the amount of money that you have in your trading account at the time, or the amount that you're willing to trade with. So just for educational purposes, we just like to keep nice round numbers. So we're just going to say you got $1,000 in your trading account. Now, leverage amount, we'll talk about this on another video to come, but my full leverage is 10 to 1, which means for every $1,000 in the account, I'm actually trading with $10,000. But more than that another time. Risk per trade. So every trade that you place, there's a certain element of risk involved in every single trade. You have to decide on what percentage of your account do you want to risk per trade. Now, I would recommend that if you're starting out and you're a new trader, then you start it off at 1%. Okay. As you get on a little bit, you might want to put that up to 2%. Only if you're very on top of your game and know what you're doing, I recommend that you put it up to 3%. But if your account balance starts going above $10,000, then reduce that down to 2% again. But 2% is a nice round number, and don't take it any higher than 3% ever. I know you get some people out there saying 5%, but if you go to the my money management section, you'll understand why trading with 5% is clearly a bad idea. So in this one, the account type. By the way, this spreadsheet is on the money management section, and you'll find a link down below. You can have access to that page if you want to, or you could do up your own spreadsheet if you're good with the spreadsheets yourself. But the account type, I've got it marked down as 1 for the mini. You put 10 down for the standard accounts. So monthly profit required, we can put anything in there at all. Anything within these green cells you can change to your own variables, and then the blue cells will tell you the numbers that you need to know. So we're just going to put down for a 10% for monthly profit required. Now, the position size comes from your current account balance, the risk per trade, and the amount of pips that you're actually risking on the system. Now, that is defined by your trading strategy. Different strategies will have different requirements. So if you're trading on a 1 hour chart, it might be 30 to 60 pips, but if you're trading a daily chart or a 4 hour chart, this is definitely going to increase. But the good thing with this is you can change the numbers, and the formulas built into the cells will work it out automatically for you. Okay. So let's just say your trading system is 40 pips for your full position size, and for the bigger moves it's 100 pips. Okay, we're just saying. So with that 40 pips and with the $1,000 in your account with 2% risk per trade, that one mini lot is going to be 0.5. If you increase it to 100 pips, the position size is going to be 0.2 mini lots. Now, as you can see here, the risk per trade is static at $20. That's because $20 is 2% of your $1,000. Okay, so this is where the position size comes from, your risk per trade divided by the pips that you're going to risk, and that will give you the position size. Okay, further on in the sheet, this will also tell you your monthly dollar requirements for your 10% profit. If you break it down to 20 trading days, it's only $5 a day. Your monthly pip target and your daily pip target. Okay, but also in this video we're talking about the values per pip. Now, at the time when I done this spreadsheet, these prices were correct, but they do fluctuate as the price goes up and down. Some of them stay pretty steady and constant, like the Great British Pound US dollar, Euro US dollar. The majors will tend to stay about the same. But as you can see, the United States dollar Japanese yen at that time was 98.3 cents, same as the New Zealand dollar Japanese yen and the Euro Japanese yen. If you trade the other currency pairs like Euro Great British Pound, at one point I do recall it was $1.46 per pip. So you will get these numbers from your broker's website. If you go in, log in, it'll be different for every broker, but there will be a section on there telling you what the values of the pips are at the current time. A good thing to do is, once you have this spreadsheet, come in, mark them down, and just check them. If not once a month, definitely every quarter. And if you do see a lot of volatile movement within the currencies, then definitely check up on it. But a lot of the time they do tend to swing back and forward through the same range. So I wouldn't worry about this too much, but do check on it once in a while. Okay, so one thing you don't want to do in your trading is to go beyond your fixed position size. Let's just say if you go through a series of losses and you want to revenge trade, which means you want to try and recoup the losses that you made on the day. And what a lot of people may do to do that is to double up their position size to try and recoup their profits. This is it's a deadly mistake, because every time you lose, you're doubling up your losses. So instead of losing 2%, you are now losing 4% every trade. And if you have this mentality, it's only going to get worse, and you'll end up blowing your account. Forex trading is all about systems and a formula, and sticking to that system that you define yourself. And like I said before, that the formula is built out of trading system, money management, and your trading psychology. Okay, so you do need a spreadsheet like this to treat Forex like an actual trading business. Good thing about this spreadsheet is not only does it have all the formulas built in for you, it's nice and simple to use. We have a trade logger, so you can log your trades, find out how you're doing on a daily, weekly or monthly basis depending on how much you trade. I like to use this on a fortnightly basis, and I can see where my trades have been going up or down. I can tell my profits, losses, nice and easily by a visual matter. At the end of the month, I come along and I record my trades on here. I'll put them down here, and this records it for the year. And puts little points up on the charts, as you can see here. So as the year goes on, I can find out whether my trading system is pretty volatile, whether I need to change anything on it, or when you get your win ratios. So you can see your win ratios as well. So this is your profit to loss factor. So for every 1 pip your risk, if you're gaining 2 pips, that's a 2 to 1 ratio, or if you're risking 10 pips and collecting 15 in profit, that's a 1.5 profit to loss ratio. Okay, so these are very, very key numbers for your trading styles. Same as your win rate. You can tell if your system is sloppy, or find out whether you need to change it or change something about yourself with your emotions or your money management. But analysis of your trading can only define these factors. So it's a good idea to have this spreadsheet. This is another one. It's a good 3 years 3-year analysis on your trading styles. So you can put your end balances in here, and once again it records it in a visual perspective so you can see what your trading style is. Okay, you don't want sharp rugged edges like that. You don't want it to be volatile. You need a nice easy exponential curve on there, and you'll only be able to see that if you record your trading activity consistently at the end of every month. This will also tell you if you put in here for your profit requirement, if you want to change it to 20%, which should be your maximum. This will tell you your projected dollar amount, like on the other spreadsheet, your dollars per day, profit for the month with the start balance. Usually what you do when you get your projected amount, you stop working. Why? You might think if you keep trading then you can probably make more money. Well, there's a couple of reasons. There's first of all, the market works in cyclical natures, which means for your trading system you'll probably go through a series of wins, and then things will change, and then there'll be due a series of losses. So that's one reason to exit the market. Another one is once you've got your profit, whether it's 10%, 20%, whatever you define for yourself, you've made your profit, so why risk giving any of the profits back? It's a hard thing to deal with, knowing that you've made your 20% and then at the end of the month you're actually minus 20%. So when you make it, stay out of the market. If you're one of the traders that can't actually stay out of the market, having a chimp account is a good idea. And what that is a separate account with a lesser amount of money, and that's just for your playing about and your gambling needs, if need be. This is an account that you're not going to grow up and compound. You're just going to mess about with it. If you make money on it, great. If you lose money on it, don't worry. But the main account, you want to leave the money in, let it compound, because let's just say if you go through this spreadsheet and you fill in your, let's just say if you were going for your 10% every week, if you take the numbers from here, your projected profit, 110. Let's just do that. So we're just going to start this off at $1,000. Okay, forget about the start date, account number, account balance. Let's just work that on there, and let's see if this works straight off the bat. Okay, beautiful. So these figures are drawn out from the formulas of just gaining 10% per month. Now, I'm in just a quick disclaimer here. I'm not claiming that anybody's actually going to achieve these results, and also gaining 10% every single month is very unlikely, because you will have months in there that are not 10%, they're going to be less, and also you'll have losing months as well. So this is it's not justified, it's not real, it's fictitious, okay? But I just want you to grasp the concept about the power of compounding, okay? Now, this was a $1,000 account, excuse me, and just by gaining 10% profit every month and then compounding the interests. So profit in month 1 was 100, then 110, then 121, then 133, and this just carries on, year 1 may be pretty slow, but as you can see from this exponential curve here, that yes, the first 2 years are very slow, but once you get to a certain point, things just start to take off dramatically. Now obviously once you get to a certain level, you wouldn't want to be looking at 10%, you'd be looking at taking that back, because you'd also be reducing your risk per trade as well, because trading with this amount of money and the amount of risk that we put on, it's extremely high. So you get to a certain level, let's just say we said $10,000 before. Once you get $10,000, you take things back a little bit, and then once you progress through the field, you do the same again. But as you can see, through a 3-year basis, you can see how the profits in the month just compound dramatically. Now, if you haven't heard it, Einstein's quote that compounding is the 8th wonder of the world, and he's not wrong, definitely not wrong. When you look at these figures, you know, it's really amazing, and all you need to do is be consistent in your trading, okay? And I was just starting out with $1,000, no more pay-ins. So learning from day 1 to be consistent, cutting out your gambling and sticking to the system is your main objective in Forex trading. Forex is a business, it's your business, you need to start treating it like one. It's not a game, and if it is just for fun, then fair enough, you don't need all these money management softwares and business plans and stuff. If you just want to throw money in, play with it and blow the account, that's fine. But if you want to treat Forex trading like a business, then you need this, and you need to stick to your plans, okay? And if you want to get a hold of this spreadsheet, link just down below. Go to my money management page, and you've got access to this. So thanks for watching this video, and I'll see you in the next one.